Bad news for the U.S. government. The federal budget deficit just surged to a near record. Government spending continues to skyrocket to multi-year highs, and interest on the debt poses a $3 billion a day problem. Is this the tipping point for America's fiscal health, or just another chapter in our endless debt saga? So here we can see we got the monthly Treasury statement yesterday afternoon. Here we can see for the month of August, the government spent $690 billion. This is the highest level going all the way back to September of 2022. Spending is a huge portion of this, as we will see. Here is the monthly deficit. Now, remember, this is the difference between what the government collects in revenue and what it spends. We spend more than we collect, so that is known as a deficit. And that is $345 billion for the month of August alone. So the gap between spending and revenue just for the month of August, $345 billion. Now, if you annualize that out as a share of GDP, it's 14%. However, that's not very useful as there's a ton of month-to-month noise. So here we're going to take a moving average, a 12-month moving average, to get a better idea of exactly how bad the deficit is. We can see it is basically 7% of GDP. And why that matters is shown here. So during a recession, which is the shaded red areas, revenue goes down, right? Capital gains tax, assets are falling, stock market's falling, people are losing their jobs, so income tax revenue is going down. Revenue decreases by about 20%, generally speaking, during a recession, at least in the modern era. However, as if that wasn't bad enough, spending is going up. So it's a K. They're moving in the wrong directions, both spending and revenue. Spending goes up due to automatic stabilizers like unemployment, unemployment benefits, and those sorts of things. Sometimes a jobs program or various programs by the government to stimulate their way out of the recession. And as you can see, deficits do go up during recessions. However, they're supposed to come back down after the recession is over. That is not what has happened over the past 25 years. We've gone from a 2% surplus, meaning the government brought in more than they spent. We actually had savings to some degree. We went from a 2% surplus to a 7% deficit just in the period of 25 years. Now, this is despite unemployment, again, kind of proxy for aggregate economic health, being flat. And again, unemployment at 4.3 is very low, at least historically speaking. Again, there's many issues with unemployment. It does not show you the silent depression that I talk often about, but it is a good proxy for kind of aggregate, zoomed out, the fact that this deficit, 7% of GDP, and is coming despite no recession, no world war. So if we're looking as a share of GDP, that is important because, again, you can think of this as deficit divided by GDP. During a recession, your GDP or balance sheet capacity goes down. Well, the deficit, or again, the way the government covers the deficit is by issuing new debt. So you can think of deficit as new debt. So the new debt is going up, right? Because revenue is going down and spending is going up. So new debt is increasing. The amount of new debt is increasing, the deficit. But you also have GDP falling. By definition, during a recession, the economy is contracting. So on average, and again, the kind of modern era, this hyper-financialized U.S. economy that we have nowadays, the deficit as a share of GDP goes up by about 800 basis points on average during a recession. So for all the people calling for a recession now, that would take our deficit as a share of GDP to 15% of GDP, meaning every year the government must issue 15% of American GDP just in new debt and just to finance the needs of the government. This is what you see in emerging markets. And by the way, in emerging markets that are highly levered and in fiscal stress, during a recession, you see yields go up. I would point out that the negative growth shock of early April with the tariffs, that's exactly what you saw in the U.S. You saw yields skyrocket higher because, again, GDP, balance sheet capacity to absorb all the new debt that must be issued, that is the deficit. You have GDP falling, or demand for all those bonds, and you have the supply of bonds skyrocketing, right? The deficit is going up. You could think of $3 or $4 trillion deficit, right? The numerator is growing, and you have the denominator or capacity to absorb that $3 or $4 trillion of debt. You have that going down. And so this is why it's so important to look at it as a share of GDP. Here's federal spending as a share of GDP. We are spending 22% of GDP, the federal government, that is. And that is the highest level, really, that we've kind of settled out at. Going back to World War II, 1946 and 47. Now, you have seen brief periods of time, again, during a recession, where spending will spike during 2008 here and then during 2020. However, again, the point is that we are not coming back down to 19 or 20%, which is what we were at going into 2020. 19 or 20% of GDP. We are settling out at 22% of GDP, which is on par again with World War II. And so this does not seem to be, it seems to be in an uptrend. It does not seem to be like it wants to set a lower low. We are in an uptrend, meaning every time we have a recession, spending goes up as a share of GDP. It comes down after the recession's over, but never back to the same level it was at before. So this is an uptrend. It is setting higher lows. It does not look like we have any hope that this is going to go back to, say, 19 or 20%, as we will see in the monthly Treasury statement, which we'll take a look at here. I will link to this in the description. Here we can see revenue for the month of August, 344 billion, total government spending 690 billion, mainly driven by Medicare 141 billion, Social Security 134 billion, and interest $93 billion just for the month of August. Customs duty or tariff revenue came in $30 billion. Again, the difference between spending and revenue, $345 billion for the month of August. Here is arguably a better way to look at it, which is on a cumulative basis. Remember, fiscal year runs from October of last year through October of this year, so we have 2 months to go. We can see revenue so far for the year, for the fiscal year, 4.69 trillion. However, spending 6.6 trillion. Again, look at that net interest, $933 billion, almost $1 trillion. And in fact, by the end of the fiscal year, it'll be 1.1, maybe even 1.2 trillion dollars of interest, just interest on the debt alone, 1.2 trillion dollars by the end of the fiscal year. Customs duty so far, again, they started halfway through the fiscal year, 165 billion. If you assume about 30 billion per month, that works out to about $350 billion. And also assuming that the courts do not intervene with the tariffs. That is a whole other situation. If we have those courts intervene and reverse the tariffs, that would blow the deficit out even worse than we'll see as it already is. The deficit so far for the year, $1.97 trillion. Now, here we're going to compare August of this year to August of last year. Spending and revenue increased, but revenue was up more, so you actually have a slight reduction August to August. However, that's not the full story. As we'll see, it's actually much worse. Here we can see, again, this month, current fiscal year to date, 6.6 trillion in total spending, 439 trillion dollars, $7.4 trillion for the full fiscal year of 2025. Now, the comparable period up through August of last year, that spending was 6.28 trillion. So spending is skyrocketing. So you can see that again through up until now for this fiscal year, 6.6 trillion. Well, up through August of 2024, the federal spending was only 6.2 trillion. So spending is going up. And if you look at next year's estimate, $7.6 trillion. So spending is really kind of the issue here. And of course, the resulting deficit, current fiscal year to date, $1.9 trillion fiscal deficit. Comparable period up through August of last year was $1.9 trillion. Again, the way the government comes up with that, they issue new debt. They issued $439 billion of new debt. Current fiscal year to date, they've issued $1.6 trillion. The estimate for the full fiscal year, they will issue $1.9 trillion of new debt. And again, comparable to the up through August of last year, $1.8 trillion. So again, here we're going to look at month to month, and we can see that revenue came in higher. That is the green bar here, August to August, and spending came in basically in line with spending of last year. The deficit improved August to August. However, again, zooming out and looking at the bigger picture, this is more important. So here we can see revenue went up, which is good. However, spending went up more. Again, this is cumulative up through this August of fiscal year 25 versus up through August of fiscal year 24. Revenue has increased, but spending has increased more. Again, if you go back here to see the spending, the total outlays, 6.6 trillion fiscal year to date. For the full fiscal year, it'll be 7.4 trillion. If you go back to prior to last year up through August, it was only 6.2 trillion. So you went from 6.2 to 6.6, and next year you're going to 7.6. So government spending is really what is driving this. And it's mainly driven by interest and Medicare, Medicaid, Social Security, as we'll take a look at in a second. We can see the deficit on a cumulative basis is up significantly compared to fiscal year 24. Here is revenue for the government by source, and you can see this pie chart. This is another way of visualizing that data here in a bar chart. Here is outlays for the government pie chart that you can look at. It does not break it down into very small categories. If you want granular detail, you have to go further down. And again, kind of generally speaking, the outlays for the U.S. government displayed that way. So here is comparing fiscal year 24 to fiscal year of 25. Again, this is really kind of zooming out. Need to look at what is the trend. And we can see a couple notable things. So individual income tax withheld, individual withheld and FICA, this is individual income tax. This is up. So individuals in America are paying 10% more in individual income tax. Look at gross corporate tax. That is down by 56%. Now, if you look at customs duties, of course, this is tariff revenue. This is up 296%. So a dramatic increase on a percentage basis of tariff revenue. Again, only about $350 billion. You're talking about, 7 trillion of government spending. 350 billion, it's kind of a drop in the bucket, but it's also not insubstantial. Now, I also want to point out Federal Reserve earnings. This is incorrect. So the Federal Reserve is operating at a massive loss. I believe it's about $270 billion. However, it's recorded as a deferred asset, so they get to put zero. This is actually not true. So the Federal Reserve is operating at a massive loss of about $270 billion. Now, HHS, other, so not Medicare, not Medicaid, other HHS spending, that is down 112%. As we can see there. Treasury, this is really, I think, what matters the most, other than the deficit going up, zooming way out. The trend is that the deficit is increasing, mainly driven by spending. Here we can see interest on the debt is up 21%. From fiscal year 24 to fiscal year 25. This is massive increase. One of the major drivers of the debt and government spending is interest. We'll get to that in a second. The net budget result, again, for the fiscal year 24, August came in $380 billion. This year came in at $345 billion. But again, it's more important to zoom out and look at the cumulative deficit as we were looking at here, which the deficit is getting worse. The deficit is increasing mainly because government spending, the blue bar here, is increasing at such a rapid rate. So I will link to those in the description. Here we can see gross interest expense, $1.1 trillion. This works out to $3 billion per day of interest that the government must pay on U.S. treasuries. So gross is not necessarily, it's a large number and it's kind of mind-boggling, but it's not the most useful way to think about it. So here is gross interest in red. This chart was provided by Zero Hedge. Here is interest on the debt compared to other spending items. You can see that interest has quickly overtaken income security, Social Security, health spending, right? Medicare, Medicaid, HHS spending. Interest has quickly overtaken those and is second only to defense spending here, which we can see in green. So interest expense, as we can see, is skyrocketing higher. That is one of the main drivers of the debt. So here we're going to look at interest as a share of GDP. It's about 4% of GDP. And again, remember the reason this matters: GDP. This is the balance sheet capacity for the interest for the new debt that must be issued to cover the interest. Because remember, the way we pay interest, the way we pay 1.1 trillion, is not out of income tax. It is out or revenue. It is out of new debt increase, new debt issuance, right? We issue US Treasuries. The Treasury gets dollars for those US Treasuries. So Treasury now has dollars that they can pay out the old debt holders their interest. So we're issuing new debt to cover the interest on our old debt. Here is interest as a share of tax receipts running at 23%. So about a quarter of tax revenue is going just to interest expense. Now, you might be thinking, well, interest as a share of GDP and as a share of tax revenue was significantly higher back here in the late 80s. I would point out that yes, but debt to GDP was down here at like 40%. So it is 3x worse. The debt to GDP is 3x worse than it was, 3 times worse than in the late 80s when interest as a share of GDP was this high. So here is Medicare. This is one of the major drivers of spending. We can see Medicare as a share of tax revenue at 24%. So a full quarter of tax revenue that the government collects in taxes, a full quarter of that would go to Medicare. Of course, we run a deficit because once you include Social Security, that is another 32% of tax revenue. So you add the two of those together, and you're at 55%. So just these two programs, Social Security and Medicare, the amount of spending, which is the numerator, has greatly outpaced the denominator, which is tax revenue. As we can see, for example, Medicare spending used to be 5% of tax revenue. Well, it is 5x'd, meaning Medicare spending has increased 5 times faster going back to the early 70s than tax revenue has. Same with Social Security. We can see back here it was about 19%, and it is 32% now. You combine the two of these, just these two programs, 55%. So here is that combination, Social Security plus Medicare as a share of tax revenue. It's actually 56%. And then finally, here is interest, Medicare, and Social Security as a share of tax revenue. That, as you can see on the far right column, 79%. Now, it's actually even worse than this once you include Medicaid. However, the data that TradingView provides for Medicaid includes, it appears, state funding for Medicaid. So once you include government funding, federal government funding for Medicaid, if you were to be able to find that metric, if TradingView had it, and you were able to add that to Medicare, Social Security, and interest, we would be at 100% of tax revenue, meaning mandatory spending, just these 4 programs, would be at about 100% of tax revenue. So one of the major problems too, as well as interest and as well as Medicare and Social Security and Medicaid increasing, the cost of it increasing way faster than GDP or way faster than tax revenue. Another major problem is the marginal return on each new dollar of debt is going down. So here in white, we see the amount of GDP that we get for each new dollar of debt. If GDP is increasing faster than the debt, the white line will go up. And sure enough, that is what we see up until the early 80s, where all of a sudden we started, the amount of debt was increasing faster than GDP. So remember, you invert this white line, it would be debt to GDP. And so that was the bottom in debt to GDP, or the top if you're looking at it in GDP terms. So if you're looking at it as how much GDP are we getting, you can see that has been in a substantial decline ever since 1981. Ever since then, the marginal return for each dollar of debt has been going down, meaning if we issue $1 of debt, we only get about 40 cents of GDP on that $1 of debt. Now, if you go to college to be a doctor, you go 200 grand in medical school debt, but immediately you graduate and you're making $500,000 a year. Well, that's a great return on your debt. However, our return on our debt is only about 40 cents on the dollar. Now, another way to look at it is GDP divided by the money supply. So this shows you Are you printing money? Because remember, that is a GDP. Government spending is GDP, and money printing goes into GDP. If you're printing money faster than you're getting GDP, sure enough, the red line goes down. And sure enough, that is exactly what we've seen. However, this time it peaked in the late 90s. This red line also is basically the same line as money velocity, and it is basically the same line as personal income divided by the M2 money supply. So we have been getting declining returns, arguably since the early 80s, but at the best case since the 90s. So with this fiscal report, we did see a bit of a pop in yields, in interest rates. It looks like it's getting a bit up though, however. So here we can see the 2, 10, and 30. We can see the 2-year did move ever so slightly on the fiscal report news. However, more pronounced, obviously, at the 10 and the 30. Those yields did move higher. However, they are getting bid down in this bull flattener that we've been seeing the past week or so. This is generally what's seen ahead of rate cut expectations, but also slowing growth. So, of course, the labor market is on the top of everyone's minds, and the dollar just cannot catch a bid, despite the fact that generally it does well during economic slowdowns. We can see Bitcoin has gotten bid the past week or so, and gold just continues its relentless increase, this parabolic move. And then finally, just to end here, as an update for the SOFR, the overnight dollar liquidity that we've been watching this whole time. So yeah, it is not necessarily improving. And again, it's common to see during month end or quarter end, when there's window dressing, firms are needing to borrow cash to make their balance sheet look good for regulators or for investors. You see it at month end, quarter end. SOFR spikes above Fed funds, maybe up to IORB. But then it reverses very quickly. The fact that we have been basically at 6 basis points for a week and a half, 2 weeks now, 6 basis points or more in spread, and it's not month end or quarter end, is certainly significant. So, it is something to keep an eye on. We have the Fed meeting coming up. And generally speaking, they don't like to see dollar liquidity or treasury market functioning. These sorts of things, when it comes to the plumbing, that is arguably their primary concern. So, is the U.S. Treasury market functioning well? Is liquidity abundant, or is it scarce? And you can see to some degree here in this kind of overnight dollar loan market, the SOFR market, you get some idea of dollar liquidity. And when SOFR is spiking, that is meaning that the demand for dollars or dollar loans is outpacing the supply of available dollars. That is why the yellow line or SOFR will spike during a liquidity strain. Now, it is nowhere near 2019 repo rate crisis levels. However, it is indicating that there is some, significant amount of liquidity issues or shortage. And so I'm sure that the Fed, if this does not meaningfully improve, the Fed might even guide towards some sort of balance sheet activity in the future. I don't think they would surprise the market unless it got really bad and actually announce and engage at this next meeting in balance sheet expansion. But 50 basis point cut, maybe. If this does not improve, this is again arguably the Fed's primary worry is kind of the functioning of the financial system, whether that's the U.S. Treasury market or kind of the overnight repo market, dollar liquidity. These are some of the prime concerns. They'll never admit it, but these are some of their prime concerns. So if you have a shortage of dollar liquidity, they could theoretically act more than the market might be expecting. Maybe 50 basis point cut. Maybe they guide to balance sheet programs, balance sheet expansion at the next meeting. This is definitely something to keep an eye on. It's currently running at 8 basis point spread. Again, this is common during month end, quarter end. You go back, all these other spikes and so forth, every single one of them came at month end or quarter end, except for the one we're looking at here. You have to go all the way back 5 years to see a point in time where SOFR was spiking above Fed funds and it was not related to month end or quarter end. You have to go all the way back here to 2020 to see that. So this is, arguably the most tight that dollar liquidity has been in 5 years, at least looking at it on a SOFR versus Fed funds basis. So, anyways, hopefully that was helpful. I will link these two reports, the monthly treasury statement, in the description, and catch you in the next one.